A very warm welcome to all investors present here today. Over the past few years, we've been refining our products and sharpening our strategies. Today, we unveil an exciting new launch you won't want to miss. Without giving away much, I would like to hand it over to you, Dr. Moth.
Thanks a lot, Jason. Markets are obviously in a frenzy, as you can see. There's a lot of risk-off strategy coming in again. You saw the gold movement yesterday, which was around 6%. The market is in a profit booking zone as of right now. I would personally tell you that there's nothing to worry about. Markets are volatile. It requires more in these kind of markets. It's more negative reasons than positive reasons that are driving the market. And every now and then, obviously, there are things that are happening. In fact, the whole of the Greenland issue, exited pretty peacefully in terms of the threat, the EU threat that was there on the US. So there are, and Dow closed in positive. So, looking at all of this, I think there's a massive round of profit booking that is happening at the current levels. And obviously, that is something that is not a sustainable move because as I have been telling you on a Monday to Monday basis, the corporate earnings are looking still strong. So if you are having a corporate earning which is strong, if you have reasonable correction which is already coming in, I think it's only a matter of time. I would say in the first quarter itself that we can get back into the fourth gear, if not the fifth gear. Today, there is a very interesting piece of information that I'm getting in front of you. This has got a huge possibility of changing everything the way that we do it. It's been 10 years. Our whole stock selection criteria is bottoms-up philosophy, which means that we do not look at sectors, we do not look at what phase of the market that we are in. We do strong stocks which are strong fundamentally and we move in out there. I am very excited to tell you that what I'm going to show you today is quite groundbreaking and that might radically change our whole scoring mechanism, our whole entry and exit into stocks, our whole sector selection, and deciphering what kind of a market we need to play what strategy. So without giving in much, it's a very, very detailed presentation. Please grab a cup of tea or coffee or water because you will need to focus on this. I am really excited about what we've done today or what we're going to do today with you in terms of showing you the next phase that is coming in. And I must tell you that this is a phase which is not something that we're saying a big launch of 2026 and we don't know when it is going to happen. It's going to happen very, very soon. So we are at a final stage of deciding things in terms of how we need to do it. And we'll have a very big change. At that time, I would personally want to do detailed training with all of you in terms of what we are changing and why we are changing and what is the impact of that onto various things. And obviously, unless the change is very huge, I would not come across and tell you because we do minor tweaking practically 365 days, 24/7, we keep doing it. But my objective of coming in front of you today is that this is not a minor tweak. This can be one of the most major tweaks that we may have done over the last 10 years. And, I would say definitely the biggest thing that we have done. So I'm going to tell you, and there's a lot of data today that I'm going to present, but, I'm going to make it as simple as I can so that all of you can understand. If I will try and cover up all the questions in the Q&A section today. If not, I would also like to do a only Q&A on this particular topic that we're discussing today, where I can spend maybe 1 hour listening to your questions and maybe trying to answer those. So with that note, let's start the proceedings and let's see what we've got in store today. Okay, a disclaimer. We emphasize that all investors should use the information in this webinar merely as a resource to enhance their own research and understanding. This is educational content, not personalized investment guidance. Nothing discussed in this webinar should be considered as investment advice. We strongly advise all participants to consult with certified financial experts before taking any investment decision. Investment in securities is subject to market risk. Past performance should not be construed as a guarantee for future returns, and historical data presented represents only the backtested results. Investments in equity and equity-related securities involve a high degree of risk. investors should not invest in any funds if they cannot afford to lose entirely. As per the agenda today, we are going to cover two things. I am going to make two big announcements today, which is my agenda number one. And there is a big reveal that we are going to do today, which will have an impact in the next 1 month on a lot of things, the way that we do it. So let's start with the important announcement first. What we are doing is moving the model portfolio, the 3 model portfolios that we have, to Infinity platform. So in the first quarter itself, from say 1st of Feb, all the model portfolios will only reside in Mojo Infinity. The same will go for Portfolio Optimizer. So if you know, we have 11 products in our basket today, right from score to screeners to Mojo stocks to turnaround to reliable to research reports to switching reports to model portfolios and to Portfolio Optimizer. So 2 of these products will immediately move to Mojo Infinity. The reason that we are doing this, I'm going to explain you why we are doing this, and I think you should be completely delighted with this particular move. Let me just tell you why we are doing this. First of all the clients will have to do KYC. There's a lot of time the KYC importance is kept aside. The reason being that you may be a conservative customer, you may be subscribing to an aggressive. So we want to move away from anybody can just pick up any model portfolio, but there is a KYC that is quite a very simple process in terms of risk profiling and KYC. It's not a big deal. The current execution rate in Infinity, for example, is closer to 80%. And the current execution rate in model portfolios is about 5%. It's a very cumbersome product. A lot of time you guys have come back to us and you've told us, can we integrate the small case platform into the model portfolios? So what we are doing, and I'm very happy to tell you today that we will integrate small case as a backend API so that you can transact directly through your broker, and the trades you don't have to update them manually. It will get updated automatically as we do it in Infinity. These features are only available on Mojo Infinity, and hence we will be moving the optimizer as well as model portfolios into the Mojo Infinity basket, where you can obviously execute cleanly, flawlessly. You can do all of that stuff. The execution will be much faster because it is a one-click execution. So it reduces the chances of error. Sometimes you are putting, the trades yourself in model portfolios. That whole need will go away. So these are automatic executions that will happen, which will reduce errors. Obviously, the portfolio rebalancing and the automatic order generation process is way better in Infinity, and we are going to integrate that in the model portfolios now. A lot of time, a lot of you have come back to us and said that give the option of adding a negative list to model portfolios. Sometimes if you're Sharia compliant customers, or sometimes if you're no vice portfolio where you don't want to take tobacco or your beverage, your alcohol based companies. So all of those grey list option will be given in Mojo Infinity. And obviously, one of the things that you need to do is to see how is your virtual portfolio doing. A great feature that we have in Infinity to tell you to follow the discipline of execution. So you will be integrated exactly in the same way that we have Mojo Infinity today on the model portfolio and the optimizer. Both these products will go in out there. Now, please understand this before you guys panic. I don't want you to panic on this one. I want you to deep breathe and understand this. New customers coming in from 1st of Feb and subscribing to Mojo subscription plan will not get model portfolio and portfolio optimizer. So our 11 products will reduce to 9 products for new customers only. Existing customers, And these two new products that are there, which is Model Portfolio and Portfolio Optimizer, which are now going to be on Mojo Infinity, will be on a AUFEs, which means that they will have to pay that 1%, 1.5%, 2%, whatever the AUFEs that we decide. So they will not be able to get this under the subscription plan. It will get removed from there, and these products will be available on Mojo Infinity on a percentage of portfolio as a fee. This is applicable for new clients only. For existing Mojo subscribers, you will continue to get it free. So you don't have to pay anything. We are just making sure that this balancing that we're doing is for better execution and a better portfolio and better integration, and chances of error reducing. So we are doing this as a benefit to the Mojo subscribers. So if you're a current Mojo subscriber, you don't have to pay anything. You've already paid for these two features, and they will remain till your expiry of the subscription plan. Once your subscription plan expires, obviously then these two features will be charged features, and that is fine, because even when your subscription expires, you can't see these features. So nothing changes for the existing Mojo users, all changes for the new users. So for existing Mojo professional users, this is just an added feature that we are giving you. For new users, obviously, they have to now have only 9 of these features in the Mojo plan. Both these features will be on a charged basis on the Mojo Infinity platform. Once your subscription passes away, which is once your subscription expires, obviously then if you renew the subscription, you will only get these 9 features, and you will have to pay for the additional 2 features. So I hope that is clear. There is no impact on the existing users. This is applicable for new users. Existing users benefit huge because of this particular move. Because of this particular thing, what we are doing is only for midnight today. We had closed this offer, as you know. We are giving you the 14,999 for 1 year with the whole of MojoOne, including Model Portfolio and obviously Optimizer, plus Stock of the Week. And we are giving you 2 years free, which is 86% discount if you want to extend, because upon expiry, then you can't avail of these 2 features. They will be on a paid basis only. So I'm not going to keep this on for beyond today. So if you want, this is an offer that was a lot of people came back to us and said that give us that 2-year offer, free offer. So we are only launching this for midnight of today. So if you want to subscribe to it, please make sure that you subscribe from the webinar link, which is below the video that you're watching. All right, now let's go and look at our second agenda, for which I'm mainly out here today. So far, over the last 10 years, we have been trying to answer which stock should I buy. So when I started Markets Mojo, and when there was, 0 competing products, or there was this research that was restricted to 100 to 150 people, we kept doing a lot of analysis. We created the dots first. And then we said that we need to stick our neck out and not just create the dot, which is somebody is putting squares, somebody is saying quality SI, that, anybody and everybody is saying everything, right? But if we have to really add value to our customers, the basic question that we should be answering today is, what stock should I buy, right? And that's the advent of score that came in. And we ran that score, we improved that score over a long period of time. But what happens is that what we did was we created a momentum-based score. So the score, which is essentially a bifurcation of quality, valuation, CFT, and technicals, was able to capture the momentum markets brilliantly. So you would know when the markets are in a kind of a bullish phase, Markets Mojo really rockets out there, right? But it also corrects a lot in the bearish phase, which is typically the way the whole IP works for us. What we are going to do now is the question that I am trying to answer this month. Can we have a dynamic score? What does that mean? In the momentum markets, can we play growth as we are currently playing? But in the bearish markets, can we go back to value? And what do we do in sideways market? So this is something that is very important for you to understand. What I'm talking about is a complete revolution on how we score companies. when the industry is in a momentum phase, we work very well. But when it is in a bearish phase or in the sideways phase, can we have an alternate score? Which means that the current score gets replaced because you are in a specifically different market phase. Because in a bearish phase, typically speaking, value becomes very important. Valuations become very important. But in a momentum phase, nobody looks at valuations. But in a bearish phase, valuation becomes one of the most important factors out there, and that's where the value investing phenomena comes in. So, if a specific company is there in a bullish phase and we are rewarding momentum more as we do today, in bearish phase the score changes and we reward various other factors more important. So a score of 86 might become a 67 just because we've tweaked around and given more importance to value investing at that point in time. I am reaching very close to have this dynamic philosophy out there, because then the score becomes a viable proposition not in a specific market cycle but across market cycles. But it's a very, very big change. Today I'm going to show you some hypothesis of why I am inching towards that particular direction and why that may become reality sooner than later. Let's go and look at some of the things that we're talking here. What we have done is that we did our first exercise, as I had promised you a couple of weeks back. We have done our first exercise of market phasing. Now, what is market phasing? So we have looked at 20 years of various indices, whether it is BSE 100, whether it is BSE 500, whether it is a mid-cap index, whether it is a small-cap index. So we have seen all of these indices over the last 20 years period. And we've defined 5 market phases under which the whole market falls. And we update this on a real-time basis. So when you look at this, we have taken various technical parameters, given them different weights to see what mirrors the market scenario very well. And today I'm going to show you the result of that. Basis this particular result, our exercise has already started of dynamic scores in various market scenarios. So that exercise has already started. We're obviously going to test that out extensively before we implement any changes. But this is a very, very top-down way of looking at things. So your bottoms-up approach is much more grounded with the market scenario that you operate in. So today I'm going to show you what this test says and how we are going to look at things moving forward. So any market, we normally say that the markets are in bullish phase, bearish phase, and sideways phase. But conventionally, the market have 5 phases. It starts from the overbought phase. Above the bullish phase is the overbought phase. So let's go from the bottom up, right? There is a phase that comes in which is oversold, which is much below the bearish phase also. So oversold phase is obviously a great phase to be in to invest new money, to increase your equity allocation. And so is the bearish phase if you go into the bearish phase, because the markets, obviously you get the best value in the last 2 phases, which is oversold phase and the bearish phase. Above that comes the sideways phase, which is a confused state, which is a volatile stage. But the sideways is an important phase primarily because from here the market can go into bearish phase or can go into bullish phase. And then you have the bullish phase, and then you have the overbought phase, which means bullish se bhi upar, it is the, it has been overbought. The companies have been, the stocks have been overbought phase. So conventionally, we've been looking at 3. Now we are looking at 5 phases of the market, which is overbought phase, bullish phase, sideways phase, and bearish phase. And then below the bearish phase is the oversold phase that we are in. Broadly speaking, without you trying to make any judgments, and because this is just a week or 2 weeks away that we're going to be implementing something, so don't make any judgments right now. But the gut feeling says that in an overbought phase, you would typically do profit booking, right? Because it's overbought. So it means that it is absolutely at the greed stage. You should ideally do profit booking. In a bullish phase, you should stay invested. You should not move out in the bullish phase. In the sideways phase, the market can move in two directions, which is either down or up. Up, we don't want to cut. So in sideways phase, you should remove your profit bookings and you should have very strong loss booking in case it goes into the bearish phase. Yeah. And obviously in bearish phase, you should shift from momentum to value. Because in bearish phase, all investors, the large investors will start looking at valuation. Their demands for valuation will be very, very low. They will pick up value companies where the valuation is not expensive, where the valuation is fair, attractive. They will pick up those companies that are available at a cheaper valuation. Nobody touches expensive things when the market is in a bearish phase. As you know, when market is in bearish phase, you will curtail your shopping. You will say that, okay, I need to buy not this, but can I take an alternative like this? So normally you will always go into value phase. And that's where the value can create wealth if you go on the value phase. As we've seen that large caps have done well, mid caps have recently done okay, but large caps have done well. The reason is that they are fairly valued out there. And hence people moved towards take a shelter on value investing and move out of momentum. But in the oversold phase, you have to look at investing and buying more in the whole oversold phase. So principally, this is the structure. Now we have to make sure that we get into this structure into our score, right? That is our challenge. That how do we get this whole structure into our score? Can I have two scores? You will see only one score, but can I change it depending on which phase of the market that I am, so that we are sharper to, and we are respecting the market scenario, and we are sharper in what kind of a market scenario we are operating. Now let's look at, I'm going to now give you a 20-year breakdown period of what the testing showed us. The first is from, so I have taken data from 2006 to 2026. This slide covers 5 years. I'm going to go 5 years because the chart is very big and I want you to focus on it. So this is a chart which is from 2006 to 2010. This is what our system said in terms of the various cycles as per our technical IP. So now if you look at this, in this particular 5-year cycle that we are speaking about, the signals change around 5-6 times. In 2006, it was in the bearish mode. Obviously, the colors tell you clearly that you are, red is bearish and green is bullish zone. And then in August 2006, it moved towards the bullish phase, and somewhere towards November, it was in an overbought phase. It remained in the overbought phase and then suddenly came to the bearish phase. Then it remained in the bullish phase. And if you see somewhere around, the signals changed around, say, Jan of 2008, just at the Lehman crisis. And it went into a bearish phase. Then it went into two oversold phases. And then finally, towards 2009, it came back into the bullish phase and then remained in the bullish phase. Let's look at the next 5 years. Now, if you look at the next 5 years, the transparent, the white patches that you see are the sideways markets, right? So if you see, it remained in the bullish, it started with the bullish phase in 2010 July. In towards Jan, it moved into bearish, remained in bearish phases, sideways to bearish, sideways to bearish. So the market was coming the same way that the market is today, right? Somewhere it was turning sideways, then but it was not able to cross back into the bullish phase until Jan 2012. That's when it went into the bullish phase, according to us, and it stayed there for a good 1 year plus. Then marginally in the bearish phase and majorly then in the bullish phase. So the good news is that the indicator selection and the weightages that we have taken seem to be predicting very well what kind of a stage the market has been. If I were to overlay the BSE 500 index on that, I have this data available for BSE 100, for mid cap, for small cap, and we are trying to look at what we can do in terms of market cap, what market caps works better into what phasing. So we are doing all of that, which is something that is an ongoing exercise before we move to decide anything. Let's look at the next 10-year breakdown, 5-year breakdown, sorry. Again, if you see, it seemed to be working. Sometimes the bearish signals are smaller. So our average bullish signal has been 100 days and average bearish has been somewhere around half of that, which is 50 days. So if you look at this particular data, you are clearly seeing that there has been every time that the market, if you barring the whole thing that you see, the COVID crash, right? From bullish phase, the market immediately came down to oversold phase in April 2020. And then from there, even though the market went up a little, but it was in the bearish phase till it found a firm trend to move and moved on into the bullish phase. And then obviously it went on to a overbought phase somewhere in April of 2021. Let's look at the final 5 years here. I'm going to tell you what the current phases of the market are. So we will discuss that towards the end. So I know that that is what you're more likely to more interested in knowing. So, but just to make you understand, it's very important that whether this thing is working or not. Now, if I look at from Jan 2021 to Jan 2026, again, majority of the time the market was in a bullish phase, barring it turned into the bearish phase somewhere in Jan of 2025. It came back in May in around 4-5 months into a bullish phase, and where it is today, I'm going to show you that. But it is, the good news is that with a fair amount of accuracy, it is predicting at least right in terms of which phase of the market you are in. The question is, how do you deploy this into our IP, and how do we make sure that we should have the capability of making money irrespective of the market cycle that we are in? Either making money or the fall should be very limited in terms of shift of momentum to value from bullish to a bearish phase. All of that exercise is currently going on, and we are very close to it. And I'm going to share that result with you as well. But let's look at some other interesting data points. Let's look at what is the accuracy of these signals. Right? So I'm going to tell you the 20-year accuracy that we've got here. 6 years is what I'm going to present today, the last 6 years. Let's look at the bullish signals first. Now, from 2006, all the bullish cycles are mentioned out here and what returns they gave. So our bullish signals are active around 71% of the time, which basically are showing you that we can be accurate around 71% of the time if I were to look at 1 month, 2 month, 3 months, 6 month, 1 year movement in terms of predicting the bullish signal. In bearish signal, sometimes the market still goes up, and our accuracy rate is around 67% on the bearish signals because the market has sometimes moved up even in the bearish signals. Now, obviously, when you look at your 100-day, 200-day moving averages, right? The market may have started correcting upwards in bearish stage, but it is still in that stage. So you always have some gains when the market from bearish comes back onto a bullish or a sideways phase. So it is bound to happen. You can never have anything. If you do 5-day, 7-day, 20-day moving averages, then your signals will be very violent and it will move all over the place. But if you look at long-term trend finding, then that will always come, because from the bearish cycle, if the stocks have to move to a bullish cycle, they will gain some before they break and come into the bullish cycle. So, but still with a larger period of moving averages that we've taken and the smoothing that we've done through the RSI factor. We personally believe a 67% is very good. Now, if you look at overbought signals, again 67% in the overbought signals. Overbought and oversold signals are very rare. They're not some things that you see, 3 times a year. So there are phases, if you look at, we've seen them in 2006, 2007, 2009, 10, 14, and then straight in 2020, which were the overbought phases. And we've been able to predict very clearly around 67% of the time in terms of calling. Overbought signal means that, again, if you look at overbought, which is above bullish, तो उस रेंज में या तो पैसा बनेगा या वो नीचे आ जाएगा, बिकॉज वो ओवरबॉट में नहीं रहेगा. इट कैन कम बैक टू द बुलिश जोन. सो मोस्ट ऑफ द टाइम इन ओवरबॉट जोन यू वुड ट्राई एंड डू प्रॉफिट बुकिंग, बट वहाँ ओवरबॉट से व्हेन इट हैज टू कम बैक टू बुलिश स्टेज, इट हैज टू लूज सम returns to come back to the bullish stage. So most often than not, you will have some kind of negative returns in the overbought stage, because वहाँ से वो नीचे आएगा, because it doesn't remain in the overbought stage for very long. So it will then get corrected and come back to the bullish stage. So that's how the overbought stage works. But having said that, where the interesting analysis is coming out is that oversold stage से, because वो तो सबसे नीचे है, that is below the bearish stage, right? वहाँ से there are 80% accurate signals that we are getting. That from there, obviously, it goes to the bearish, and then it goes to sideways, and then bullish, and then maybe oversold. So the signals are very good. The interesting thing is the returns are very good in oversold market. That means this shows that a lot of smart money or large institutional money starts coming into this particular phase, where they know that this is the rock bottom, and from here there is only one way, which is typically up. And that's the reason that you have a lot of money that can be made even in the oversold stage, but for that you have to put more money. So that is at a 80% accuracy rate. Now let's review the current period. Let's look at till today, which is still say January, I think we have data of January 14th, 15th. What has happened, because there's a rapid downfall that has happened, what has happened into the various indices? Which zone are they in today? आज large cap, mid cap, small cap किस zone में है of the market, right? So let's look at that data. Now let's look at BSE 500. Let's start with BSE 500 first. So since 2023, if you look at BSE 500, this is now a closer view of 3 years, and then I will tell you the view right now, where it is right now. So we were in a bearish phase somewhere in Jan 2023. Then it was completely in a bullish phase for till around October 2024. There was overbought signals. It break that also. It remained in the bullish zone, and it was it was in the bullish zone. And then towards Jan 2025, BSE 500 came into bearish territory, and it remained in bearish territory till around April of 2025, from where then it went back into the bullish category. So this is how BSE 500 operated. Let's look at BSE 100, which is essentially the large caps. Now, if you look at BSE 100, again followed very similar trend for a shorter period. In Jan 2023, it was on the bearish side. Then it went into a very, very long run of bullish. Then came in Jan of 2025, went back into bearish, and obviously then turned back and moved into the bullish zone. Let's look at mid cap. Now this chart will show you that mid cap has been struggling. If you look at mid cap here, the Jan 2023 cycle is very similar. Till October 2024 is very similar. But if you see that from 2024 October, it has predominantly remained in bearish zone. Only lately, towards Jan, it started coming back into the bullish zone. But otherwise, it has remained predominantly in the negative zone versus large cap, which remained in predominant bullish zone during recent times as well. Let's look at the small caps. So small caps, if you look at here now, there are two things that are coming out. One is obviously it even touched the oversold signal somewhere in March 2025. Rebounded back, remained in bearish zone, then came in bullish phase and now entered the bearish phase again. That's one way of looking at it. The other is that the strips are very thinner. That means it is volatile. It moves from bearish to a bullish phase very rapidly, at least sideways it comes in and then goes back. So this phase of the last 1 year shows you the amount of volatility that is there with which these indices are moving. I will, as I said, come back and show you what phase which indice is today, which is this slide. Let's blow this up. Now if you look at this BSE 100, BSE 500, BSE mid cap, BSE small cap, they've all turned bearish as on 22nd of Jan. The only difference being small cap turned bearish on 25th of November 2025 itself. So it was already in a bearish zone. Where have they moved from? BSE 100 was sideways, then moved to bearish. BSE 500 was sideways, moved to bearish. But mid caps have moved from bullish to bearish phase. And small caps were in sideways, they had one level of drop. Where were these two phases back? Apart from BSE mid cap, which was sideways, all the other three were in the bullish zone. One of the things that is a sign on these particular parameters is that the average in the historical times that we saw was closer to 100 days, 80 days that the one particular zone was lasting, and the bear cycle, which is the bear downward cycle, was lasting on an average 40-50 days. So market is more on the bullish side than on the bearish side. On an average, I'm talking about over the last 20 years. But if you look at the dates here, it's very interesting. It will tell you how selling is happening and how buying is happening. It will tell you how volatile the market is, because these signals are in the last 3 times have changed over a week to 2 weeks time. So there is no story that you need to take back that now we are in bearish phase unless it stabilizes, because it can happen that market goes up maybe 1 to 2% or 3%, and these can again go back into sideways to bullish because the phase is extremely volatile. This is an exception. This is not something that we've seen a lot of times happening before, that the phase movement has become quite rapid. Now we have to make sure that when and if we try and crack a dynamic score basis the market with playing value as well as playing momentum, we should not change our scores on a day-to-day basis. So it has to stabilize in a particular phase before we say yes, it is a bearish phase, and hence we are going to play value, and hence valuation becomes very critical to us. We will put a very, very high weight on valuation when we evaluate. And if it is in the bullish zone, we should wait before we call it as the bullish zone and then say that, okay, now I think the momentum is coming back, and how we need to play momentum and so on and so forth. So there are various other parameters like volume assessment and so on and so forth that you look at in these parameters to define whether these stages are transitionary or they are becoming more like a 30, 40, 50 day kind of an affair. So that, you need to know before you look at this and say, mera to weekend kharab ho gaya. Predominantly because everything in a bearish zone, you need to see, because 2 days back it was in bullish or sideways zone, right? So we'll have to just wait to let this data stabilize. Now, interestingly, let's compare what happens with what we did now was we overlaid our scores and we saw that ये market phase में हमारे strong buys कैसा करते हैं? Are they specific with any market phase? Are they do better in a certain market phase, worse in the other market phase? Let's look at all of that, right? So Let's look at the strong buy, buys, hold, sell and strong sells. This data is from 2019 onwards. So it's a 7-year data almost that we are presenting to you. In overbought stage, the strong buys and buys normally give around 8.7, 10.3 kind of a thing. And obviously hold, sell and strong sell also give you returns in an overbought stage. In a bullish phase, we do exceptionally well, as I was telling you, 41%, 21% buys, 10% holds, sells at 5.6% and strong sell at say 4%. In sideways, everything drops out. You have a range of around 2.3 to 1.4. Sideways market has to be perfected. Bearish market, we are still okay in a bearish market, but it can be better if we do a value play out there. And obviously in the oversold market, you have everything that even a strong buy or a buy, typically in an oversold market, may not work, primarily because of the sentiment in the market. But decent performance in bearish market, according to me, if we leave the first two, overbought and bullish, which is fine, which tells us that our momentum strategy works during these times. And if we work on sideways bearish and oversold stage and try and balance that out with a value play, then there might be a game-changing IP that we can create by having a dynamic scoring mechanism. So 4 non-negotiables that we've seen is that the grade strong buy and buy obviously works the best in a overbought or a bullish kind of a market, which is, has delivered around 41.6% CAGR. Identifying of the phase matters because when you change the phase, that CAGR can go away. Sideways is a very dicey market. You need to be very clear of what you need to do in the sideways market. Whether we do a loss booking and let the profit booking carry on, we have to be very clear about what we need to do because it can neutralize a lot of selection. And small caps, strong buys and buys have got the best 6-7 year CAGR with around 55.3% across markets. So sooner or later, whether it is in bearish phase today or it remains for 3-4 months, what it tells us that if I were to look at the history and the data, irrespective of what happens on a 3-5 year cycle, small caps are by definition the winners. Despite it may break a lot, it may go down a lot during bearish or oversold markets. So that's a very clear indication that is coming out. Now, what is it that we are thinking and what is it that we are possibly going to do? Is today what I have showed you is that the market phase IP that we've created as a standalone IP definitely is working and working way, way better than what I had expected. The challenge now is that how do we implement that onto the score, right? In which market, what weights to be changed, what importance to be given, rather than having one IP, can we create a dynamic scoring mechanism depending on what phase of the market we are in? Can we do that for large cap, mid cap and small cap separately? To give you an example, when you are in a bearish phase, the largest correction happens in small cap and mid cap, primarily because they command a higher valuation and the market expects them to drop the valuation, right? So you can create a very stiff barometer of having a valuation weight of say 30, 40, 50% to make sure that only attractive companies are being valued at say strong buy or buy. But that may not apply for large caps because large caps are anyways at a decent valuation. They are not at a 90p, they're not at a 50p, 70p and all. All your 50, 70p stocks, which are momentum stocks, come under pressure in a bearish market, primarily because the market wants to drop their valuation. So the dynamic score is not one score again that will apply across. We will see what is the best dynamic score for large caps in bull and bear markets. And the same way in bull and bear market, what is the best score dynamic mechanism that we can create for mid cap and for small cap. The learning then we will take to a portfolio level, which is the improvement of the entry and exit criteria, market cap allocation, what market cap breaks or works the best in a specific market phase, concentration, whether we should expand it to 20 stocks, whether we should concentrate it to 7 stocks, those decisions, and overlay of the sector intelligence, which is something that we are already working on, that with the market phase, can I be in the right sector, can I be in the right stock? So these are the phasing out that we are going to do. Our next phase, after we complete this, would be to then put in the sector layer in on making sure that how they affect the scores and the portfolios. So my team and we are working day and night on this. I thought I'll tell you the results. That first chapter is over, which is the market phasing. We are fine with that. We're going to go ahead with that. And now the bigger decision that comes and stares us is that how do we try and make and, kind of go in and make the bear market our friend rather than our enemy, a sideways market as our friend rather than an enemy which has been there over a long period of time. A very tough thing to do because no fund management house, no advisory house, no research house will be able to play both sides of the market. So this is a very, very tough thing. It may sound easy to you. You may think that I pehle kyun nahi kiya, but this is not something that is so easy. Otherwise, you would typically go towards and say that I can play bear market as good as I can play the bull market. It has to change a lot. Your thought process has to change a lot. Your mindset, your IP has to change a lot. Your data has to change a lot. So all of that is a very, very tough process. And I can tell you, if we can do that, we may be the first who would have tried to do a decent work on bull, sideways, and the bear market scenario. For people who joined late, this is an important announcement. I'm going to do this again. We are moving the model portfolio and portfolio optimizer outside of MojoOne. It will not be a part of the subscription plan anymore. These two products will go into Mojo Infinity. They are going to migrate into Mojo Infinity. They will no longer be available on the MojoOne subscription plan. Why are we doing this and why it's a great effort is because all clients will have to do KYC. They'll have to look at their whole risk profile before they subscribe to a portfolio. Our execution rates are pathetic, very bad in model portfolios, currently at around 5%. We want to take that up, and hence what we're doing is we are integrating small case for model portfolios as well, which will be a one-click execution. You'll be able to seamlessly execute, no manual errors. मैं portfolio update करना भूल गया या मैंने किया ही नहीं है तो उसको मैंने discontinue कर दिया. All of those things we don't see in Infinity, and that's the best practice that we want to go get on the model portfolio side as well. Portfolio rebalancing is seamless out there. You can put a grey list for things that you don't want to invest in the Mojo Infinity platform when the model portfolios will get integrated out there. And obviously you will also get a virtual portfolio which will tell you if you're not executing how much you're losing out there. This is an integration that you guys have been requesting for the last almost a year, and we are now doing it. One of the things that you need to know and understand very clearly is that moving forward, model portfolio and optimizer will have a AUA fees. So whatever we may decide, say 1.5%, if you're invested 10 lakhs, that is a 15,000 rupees amount. That is how these two products will be priced under Mojo Infinity. But don't panic, nothing changes for MojoOne subscribers. You will keep getting it free till the time your Mojo subscription is there. Once your Mojo subscription expires, and then if you renew it, at that point in time, you obviously will not get these two features. You'll have to pay them separately. For new investors and new users, from 1st of Feb, when they come in, they will not get model portfolio and optimizer in their subscription plan. That will be available separately and priced separately in Mojo Infinity. But for existing users, till your subscription expires, you will obviously, we have committed to you, you will obviously keep getting it free. Because of this, a lot of users may want to extend their packages so that they maintain the free status of these two products. And hence, for only today, since I'm doing the announcement today, we are relaunching the 14,999 for 1 year plus 2 year free offer. This is a 3-year pricing. If you want to extend your subscription, you can do that to make sure that these two products are always a part of free for you guys, and you're extending your expiry, and you can do it multiple times as well if you want that. If not, then that's also great. But if you want to have a long-term benefit of keep using these parameters free, it is better to extend your expiry date of the MojoOne package. With that note, the links are below. They are not available on the site. The links are below only. If you want, you can do it. We will close the offer on midnight. We will send an email to everybody as well, people who are not on this webinar, so that they can avail of this as well. All right. Thank you so much. And I would say very exciting times. You only learn when markets are in such phases. So very, very good times for us to do that. And I will keep you posted of future developments as and when on a weekly basis, so that you are updated on that. Thank you so much for joining in.